Well, the dollar is just going to get killed. I mean, it's going way down. In fact, if you look at the leading indicator of the dollar index, look at the Swiss franc, which is kind of like the canary in the currency coal mine. The dollar's at a 13-year low against the Swiss franc as we speak.
The dollar is dropping, gold is trading near all-time highs, and the Fed is about to cut interest rates again. It's the why factor that's on many investors' minds today, as in why is this happening? Bulls will tell you it's because we're heading into a soft landing. Today's guest has been warning of a different outcome. In light of recent market action, his words are well worth hearing. I'm Mike Larson, editor-in-chief at MoneyShow and host of our MoneyMasters Podcast segment. Today, I'm speaking with Peter Schiff, chief global strategist at Euro-Pacific Asset Management. Peter, welcome to the podcast.
Well, thanks for having me on as a guest.
Hey, glad you could be here. A lot of things going on in the market, so I think we should dive right in. And when I had you on the podcast back in February, you talked about your expectations for resurgence inflation, resumption in Fed money printing, and economic recession. What are you seeing that's changed, if they have, and why or why not?
Well, no, nothing has changed. Everything I was warning about is happening. In fact, it reminds me very much of the lead up to the 2008 financial crisis. I was a regular at the Money Show in the years leading up to that crisis, predicting it. And it was pretty obvious to me what was going to happen in the mortgage market and the effect it was going to have on the financial system and the broader economy. But the mainstream investment houses were completely oblivious to this. In fact, most of them would have gone bankrupt back in 2008 if the government didn't bail them out. Well, I think the situation today is eerily familiar in that we have a major economic disaster looming on the horizon. That should be even more obvious than the 2008 financial crisis, yet the same players are oblivious once again. And they're going to suffer, their clients are going to suffer. And that's why it's very important that people who are coming to the Money Show make the changes that are necessary to their portfolios and make them quickly. Because I think the consequences of not doing that are going to be catastrophic. People made money in the 1950s and the 1960s by buying popular stocks, indexes. They called it the Nifty 50 at the time. One decision stocks was what they said. The only decision is to buy. You don't have to sell because they just go up forever. Sure. The names of the day were Polaroid and Xerox. I mean, nobody would really think about those names today, but they were the Nvidias of their day. And people made a lot of money in those stocks up until the mid-1960s. But if you didn't get out of those stocks by the late 1960s and you stayed in them for the 1970s, you got decimated. The people who made money during the stagflationary period of the 70s invested in commodities, gold, oil, stocks related to commodities. They invested in foreign currencies, in emerging markets. But if you stayed with what worked during the 60s and 50s, you just got killed. So situation is similar today. There's going to be a major shift in the performance of various asset classes because of what's about to happen. And this is the key that you need to understand. So ever since the 2008 financial crisis, the Fed has solved every problem by creating inflation. Right? That's what quantitative easing is. It's just a euphemism for inflation. You print money, you artificially suppress interest rates. Now, all the while they got away with it because they claimed that inflation was below their ridiculous 2% target, when it was actually above 2% the whole time. It's just that the way the government measures inflation is deliberately not accurate. So we never had inflation below 2%. It was above it, but they could pretend it was below, and they used that as a pretense to create inflation to prop up the financial markets, to prop up the economy, the U.S. government, to monetize massive budget deficits, which are now running at $3 to $4 trillion a year. I mean, it's just going parabolic right now on the national debt, which is better than 35.35 trillion as we speak. But those inflation chickens that the Fed has been releasing in earnest really since 2008, but even before, are finally starting to come home to roost. We saw the explosion of the CPI, the official measure of inflation, up above 9%. It's since moved back down to about 3%, but it's been basing it around 3% now for over a year. And inflation is about to turn up and head back towards and above 9%. But in the meantime, the Fed has already declared victory in the inflation war, and it's poised to start cutting rates. This is going to create a huge problem because, first of all, the reason the Fed stopped hiking rates, and they did that too soon, was because banks started to fail, and more would have failed had they kept hiking and had they not bailed them out. But the Fed never raised rates high enough to effectively fight inflation because they needed to reduce borrowing and spending. They needed to bring down debt finance consumption. That didn't happen. Government deficits exploded to record highs despite the rise in interest rates. Household debt, record highs. Credit card debt, record highs. Personal savings, record lows. The opposite of what has to happen to fight inflation. So the Fed has actually been stimulative the whole time. It's claimed to be restrictive. But it had to pretend that it won the inflation fight so we can concentrate on the collateral damage of that, fake fight, because the economy started to buckle under the weight of 5% interest rates, which are still historically low. We're, I think, already in a recession. It's just that the data doesn't acknowledge that, although manufacturing is probably in the worst recession we've ever had. But the overall economy, based on the way the government keeps score, is still technically not in recession, although I think those numbers will be revised after the election at some point to show that we are in a recession. Just like the Great Recession of 2008, they backdated that a year. They called it in December of 08, but backdated it to December of 07. So they wiped out a year's worth of rosy data and said, hey, we were wrong. Here's the real data. We've been in recession the whole time. We were telling you the economy was great. And I think that's going to happen, especially with the labor market, which is really a disaster. We got the non-farm payroll number today, and everybody focuses on the headline number, unemployment at 4.2. That was a slight downtick from 4.3. But the U6 rate went to 7.9. That's the highest in 3 years. But the U6 rate used to be the actual rate up until 1994. That was the only rate they reported. And that's far more accurate. So the true rate of unemployment is closer to 7.9, which is historically a very high level that you only get like at the worst of a recession. But even that doesn't tell the whole story. The true number is well north of 10% if they really measured it the way they did before 1994. But so the Fed realizes that the economy can't survive. This bubble economy that was erected on the foundation of cheap money and inflation is collapsing. So now the Fed has to start cutting rates to keep it propped up. But that is going to be the catalyst for the resurgence of inflation. And this is the toxic cocktail that, we're about to drink. Because now, what is the Fed going to do? All of a sudden, inflation comes roaring back and the Fed's cutting rates. Now, if the Fed returns to rate hikes to fight the resurgent inflation, we get a stock market crash, a complete collapse. We get a financial crisis worse than 2008. Lots of banks fail. And the U.S. government is forced to default on a lot of its obligations, like paying interest on the national debt, making Social Security payments or Medicare payments or pension payments. It's going to be a real disaster, and nobody gets a bailout the way they did in 2008, because the only reason that we got bailouts was because the Fed cooperated by creating inflation. But if it's fighting inflation, nobody gets bailed out. So either the Fed does that, or the Fed decides we can't do that. That's a political non-starter. So we're going to allow inflation to just run away, and we're going to keep rates low anyway, because we're trying to prevent that financial crisis and prop up the economy. And then you get a dollar crisis, which ultimately becomes a sovereign debt crisis. The price of gold goes ballistic. Dollar collapses, and it's, you get a complete repricing of assets.
There's so much to unpack there.
Have to prepare for that. They don't have a lot of time.
There's so much to unpack with that I want to try and see if I can hit on a few major points because of what people are talking about there in the markets right now. So it's pretty fair to say in this soft landing, no landing, hard landing debate, I think I could see where you come down on that. How bad? What do you see unfolding with the data in the rest of this year, just given what we've already seen when it comes to some of the jobs numbers you mentioned?
Well, look, the data is bad. It's going to get a lot worse because the data we're getting isn't even legitimate. Every time the government gives us data, they revise it and make it worse the following month. And they hope nobody notices that because they're focusing on another, lie that they're going to retract a month later. This game has been going on for years now, and they seem to be getting away with it. But the reason that Joe Biden was the most unpopular president in history, the reason that Kamala Harris was the most unpopular vice president in history was because the economy was lousy. And the voters were blaming it on the incumbents. And that hasn't changed. In fact, even though Harris had this little bump in the polls based on the manufactured media coverage, that's already fading. And it's going to fade a lot more come November because the economy will clearly be even worse then than it is now, and inflation will be higher then than it is now.
Peter, let me ask you about the stock market situation here. I mean, the bull case is, hey, what started to happen in July and August was just rotation. Sure, you lost the tech and the AI names, but other things picked up. Any thoughts on that? You think that's just spin, or what do you think is going to happen in stocks as we head further into the year?
Well, the stock market is clearly overpriced, no matter how you want to measure it or define what valuation metrics you want to use. But it's been propped up by artificially low interest rates and inflation. And the markets are expecting more of the same. Everybody thinks it's back to business as usual. The Fed's going to start cutting rates. They'll probably go back to quantitative easing. And everybody thinks it's going to be similar to what the Fed was able to conjure up in the past. But it's not going to work this time. I don't think the illusion is going to work because inflation is already out of the bag. Right? They can't pretend that inflation is too low and that we need more of it when inflation is the biggest economic problem that everybody acknowledges. And so when the Fed can no longer get away with creating inflation, it's then that's it. And so I think that when the Fed starts cutting rates and more importantly goes back to QE, long-term interest rates will probably rise, not fall. And this is something that we have not experienced in the business cycle. Because what's been happening, in recent memory is, the economy goes down, some people lose their jobs, but interest rates go down. So indebted consumers catch a break, they can refinance their mortgage, or they can go out and buy a car with, cheap financing. Well, what's going to happen in this downturn is rates are going to go up. So that's going to compound the problem by not only taking away the lifeline that consumers have relied on, but throwing them an anchor. Because you're out of a job, but if you had an adjustable rate mortgage, that's going up. And you can't refinance your mortgage even if you had any home equity because rates have gone up. Oh, your credit card rates have gone up. The auto loans, rates are going to go up, right? As people are losing their jobs and losing their income, and that's also going to be a huge problem for the government that's trying to finance multi-trillion-dollar deficits. I mean, if we've got a deficit now of around 3 to 4 trillion a year, what's it going to rise to during the next official recession? 5 trillion, 6 trillion a year? How's the government going to finance that, and at what price? I don't think it's even financeable in the private markets. The only way to finance that is have the Fed print the money.
Peter, you mentioned the dollar earlier. If you look at something like the DXY dollar index, we're kind of hanging by our fingernails at 100, 101 level. What do you see happening there, and what's that going to mean for investors as well?
Well, the dollar is just going to get killed. It's going way down. In fact, if you look at the leading indicator of the dollar index, look at the Swiss franc, which is kind of like the canary in the currency coal mine. The dollar's at a 13-year low against the Swiss franc as we speak. And the dollar is only about 7% above its all-time record low against the Swiss franc. So that really shows you what's happening to the dollar. And of course, gold, the ultimate barometer, is around $2,500 an ounce. That clearly shows that the Fed is too loose and it's about to make a major policy mistake by loosening further by cutting interest rates. So the dollar's going to go down, and obviously this is going to have major implications for investment returns, because for the last 10, 20 years, really, the dollar has been a tailwind and has helped U.S. assets outperform global assets. Now it's going to be a headwind, and it is going to result in a significant underperformance of U.S. stocks relative to the rest of the world, because the currency is a big factor there. And that's one of the reasons that I've already positioned myself, and I encourage everybody who's coming to the Money Show or listening to this to do the same thing. Divest of U.S. assets so you can get out of dollars and get into international assets that are going to be priced in other currencies and that are going to earn their income in other currencies, and therefore the returns that you'll enjoy will be significantly greater, I think, by orders of magnitude than what you're going to get in the U.S. And also you want to focus on commodities or types of companies that do well when there's a lot of inflation. Some companies benefit from inflation, others are hurt by it. And you also want to have companies that can at least be neutral, where they can raise their prices to offset an increase in cost. So you have to be the type of business that is selling products that people need, that they're going to buy no matter the price. Maybe they'll buy a little less, but they still have to buy your products or your services. You don't want to own companies that are selling discretionary items, things that people want, but if they can't afford it, they'll have to go without it. That's what most of the U.S. stock market is comprised of. Things that we don't really need, we like, but we're not going to be able to afford them, especially when the dollar collapses and renders all those things unaffordable.
So Peter, any particular, you've talked about commodities, you've talked about foreign markets, any particular foreign markets that look specifically attractive? And within the commodities arena, do you like things like precious metals more than base or growth type commodities like oil? Just kind of curious for some perspective there.
Yeah, well, the precious metals are my favorite. I think gold's going to be remonetized. I think this coming dollar crisis is going to be the end of the dollar's reign as the world's reserve currency. And I think the world's going to go back to gold, which is the standard we were on prior to Bretton Woods. In fact, even following Bretton Woods up until 1971, the dollar standard was a gold standard because the dollar was redeemable on demand in a fixed quantity of gold. And so that ended in 1971. And I think the dollar's role is now going to end as well. It just took quite some time, over 50 years, for this to happen, but it's happening. And so gold's going to be a lot higher. And so gold-related equities, I think, will return tech-like returns, even better. I think you're going to maybe even like cryptocurrency type returns that some people enjoyed. I think these things are going to go way up. And so I would encourage people to buy them. We run various strategies at Europe Pacific Asset Management, separately managed accounts that focus on the mining sector. I also manage a mutual fund, the Europe Pacific Gold Fund, which anybody can buy no load. EPGIX. EPIGX is the symbol for the no load. I think that's the advisors class. It's the no load version of the fund. So you could buy that anywhere, or you can certainly talk to the advisors at Europe Pacific Asset Management. But we also have strategies that are more broadly focused on value stocks, dividend-oriented stocks, and we have investments all over Europe, Southeast Asia, South America, Australia, New Zealand, just Scandinavia. Individual companies that we think are good value stocks. And in fact, many of our stocks, even with today, with the Dow down 400 and change, the Nasdaq down 2%, several of our value stocks are hitting new 52-week highs today. I mean, you're seeing a shift, and I've been observing this for the last several months. Beneath the surface, investors are pricing out the soft landing, and they're moving away from growth-oriented names to value names, out of cyclical to more defensive type of stocks. But the ultimate shift that people need to make is out of U.S. stocks into foreign stocks. That's what's coming, and you want to get ahead of the curve, and you can do that by working with us and transferring a portfolio to Europe Pacific Asset Management so that we could manage it for you and get you properly positioned for what's about to happen.
Peter, and that's a great place to wrap up, but I did want to give one last mention. You're obviously going to be joining us at the Money Show Orlando. It's running October 17th to 19th at the Omni Orlando Resort at Champions Gate. Any last minute sneak peek or tidbits you want to share about what you're going to tell people there that we haven't already covered?
Well, it depends on, what breaking news happens between now and then. I'm sure there'll be some new things that I could discuss, but the theme is going to be the same. Hopefully that everything wouldn't have already collapsed, so it's not too late to make the necessary changes. You never know. We're just, it could be one day away from a complete meltdown. I think our fate will be determined probably while we sleep in Asia, because that's where the biggest creditors are, who hold most of U.S. government debt and most of the dollars. But if we're lucky and everything hasn't completely imploded by the Money Show in October, then I'll be able to speak with you in person. We'll have a booth. We'll have some of our representatives there to talk to you about the strategies that we offer and how they could fit in with your investment portfolio.
Great, Peter, again, thank you so much for taking some time out here to chat with me. Listeners, viewers, if you're watching this, Peter is going to be again joining us for the Money Show Orlando. It's October 17th to 19th at the Omni Champions Gate there in Orlando. You can find out more by clicking the link in the video description. And again, if you like the video, you like what you heard here, don't forget to like and subscribe. Peter, again, thank you so much for your time.
Great. Thanks a lot.